my colleague Sri Anand Sinha, Director Sri Sambamurthy, and all of you present here. As Director Sambamurthy said, for the fourth year on a trot, I'm having the pleasure and privilege of attending the IDRBT's annual award function for excellence in banking technology. Every time I come here, I'm impressed by the energy and enthusiasm with which IDRBT pursues its mandate of improving banking technology. Before coming into this meeting, I had a short meeting with the panel of eminent professors and faculty members of IDRBT, and I was tremendously impressed by the earnestness and enthusiasm with which they're bringing about a silent revolution in banking in the country. Over the last 5 years, under the leadership of Sri Sambamurthy, the Institute has made impressive progress in several areas. They've trained, I'm told, officers in bank right from scale 1 up to some of the current chief executives of the banks. But they go beyond that. They go beyond training to evangelize banking technology adoption. I want to recognize here some of the very many achievements of IDRBT. They have pioneered the development of common standards for various aspects of IT banking, the latest being standards for smart cards and micro ATMs, which will go a long way in furthering financial inclusion. IDRBT has established a unique CISO forum, which, among other things, is developing as a platform for sharing common concerns among banks. And IDRBT has earned a formidable reputation for the quality of its teaching programs, as evidenced by the placement record of the students. And just now we heard Director Sambamurthy tell us how they're pursuing futuristic technology trends. So in many ways, what IDRBT is doing is improving the quality and efficiency of banking in the country in a very silent, but in a very forceful way. So, before I say what I have to say, I want to place on record the Reserve Bank's deep appreciation for the achievements of IDRBT and for the leadership of Sri Sambamurthy over the last 5 years. Thank you very much. At IDRBT here today, we are recognizing and celebrating financial innovation. Innovations that we believe will contribute to making the financial sector more efficient and user-friendly, and thereby contribute to growth and welfare. So I thought this is an appropriate platform for me to share some thoughts on responsible regulation and responsible innovation in banking. If you look back, the history of human progress is history of innovation. From the discovery of fire to the invention of the iPad, from the invention of the wheel to the discovery of the Higgs boson last year, human progress is in a way history of innovation. We all acknowledge, we all understand that for innovation to flourish, we must let a laissez-faire regime flourish so that innovators do their work and are able to reap the benefits of their innovation. But we also recognize that innovations must be regulated. For example, we recognize that drugs, before they're put on the market, must be tested for safety. We recognize that cars and automobiles and airplanes must be tested for safety before they are put to use, for safety standards. The case for financial regulation rests on the same logic, although it is not equally well understood. The logic for regulation is quite robust, but the frequent criticism against regulation has been that it stifles innovation. So the challenge for regulators, some of them are present here. The Reserve Bank itself is a regulator. Mr. Vijayan is present here from IRDA. The challenge for regulators is to protect public interest while at the same time ensuring that innovations that will potentially add value are not stifled. And this is what I call responsible regulation. The worldview today is that we had the global financial crisis because regulators did not behave responsibly towards innovation, in a sense that innovation got ahead of regulation. Against that background, in my address today, I want to focus on 5 questions which are listed there. In what ways are financial markets different from other markets? What do these differences imply for responsible innovation and regulation in the financial sector? Is all financial innovation good or bad? And what's been the Reserve Bank's approach to responsible regulation? And finally, and importantly, a question, does financial regulation have a role in promoting equity? So my first question is, in what ways are financial markets different from other markets? I want to cite 4 ways in which financial markets are different. The first difference between financial markets and other markets is that financial markets are not self-correcting. Right from Adam Smith, we know that prices adjust to equate demand and supply. That's the basis of competitive markets. But that equilibrating between demand and supply by price does not happen all that easily in financial markets. This dictum of competitive market does not run in financial markets. When a bubble builds up, it builds up to dangerous levels before an implosion takes place. We have by far the biggest illustration in the US housing finance markets, the subprime crisis. The point is, financial systems can contain pressure for much longer than you think is possible. Therefore, pressure builds up to a dangerous level and an implosion takes place. And when an implosion takes place, it can be quite disastrous, even catastrophic. The second distinguishing feature of financial markets is that financial institutions, particularly banks, are highly leveraged, and financial sector is highly interconnected. I've said this many times before, but it's very important for us to realize that this interconnectedness has implications for stability. If, for example, a manufacturing concern like cement factory fails, who loses by that? The owners of that company, the banks who've lent to that company, employees of that company perhaps, but the damage is contained. If a bank fails, that damage transmits across the system to the banks, to other banks, to financial system in the country, and from one financial system to financial systems across the whole world. So the second difference between financial markets and other markets is that financial firms are highly leveraged. The third defining characteristic of financial markets is that they're procyclical. Financial firms, of course all firms do, but financial firms more than other firms are procyclical in the sense that they all have a tendency to overexpose themselves to the same risk during an upturn and become overly risk-averse during a downturn. This, of course, is the familiar fallacy of composition, that a particular business model, if adopted by one institution, might be profitable, but if everyone adopts the same model, collectively it's not profitable. That's why even if individual financial institutions are healthy, a collection of financial institutions, a healthy financial institutions is not necessarily a healthy financial system. Finally, the fourth way in which financial markets differ from other markets is that financial markets are reflexive, in the sense that our beliefs about what might happen often influences what actually happens. The Economist magazine some time ago asked if more hurricane insurance is written, is a hurricane more likely to happen? Is a hurricane more likely to occur? Common sense says no. Just because a hurricane insurance is written, you would not have more probability of a hurricane. But in the financial sector, that is not true. The more financial insurance is written, the people who are writing insurance can make that contingency happen. So that's why financial markets are different. They're reflexive. I've gone at length about this various ways in which financial markets are different in order to emphasize how they require a different approach to innovation and regulation. So let me move on to that second question on my list. What do those differences of financial markets imply for responsible innovation and regulation in financial markets? One of the fundamental assumptions of economics is that human beings are rational. That is the intellectual foundation for this libertarian philosophy of political economy, which believes that it is unnecessary, even improper, to stand in the way of people making independent choices. If somebody wants to eat chips for breakfast, chips for lunch, chips for dinner, why should public health department of the government spend money telling everybody don't feed your children chips? If some people don't want to save money for their retirement, is it the responsibility of the government to tell everybody, look, you've saved some money for retirement? Is it the responsibility of the government to impound some of our salaries towards saving? So that's the libertarian philosophy, that the government should not interfere. Let people make choices. If they make wrong choices, it's for them to correct them. But that libertarian philosophy has been challenged in many ways, both in the academic and policy domains. The main criticism has been that the concept of rational human being does not hold. That rational human being is a theoretical concept. That's textbooks now have started calling it an econ, that a rational human being is an econ, who is by definition calculating, unemotional, selfish, and fully informed. On the other hand, people are humans. They're not econs. Their decisions and actions are driven by emotions, by biases, by judgments, by selfishness, and they're also handicapped by lack of information. And even if they have information, they do not have enough knowledge to make informed choices. So the argument is that the state has to interfere. If people are eating too many hamburgers, even if you cannot say how many hamburgers they must eat, you say how much calories the hamburger has. The government cannot say that, hotels which sell puris must have only so much oil, but the idea is to have a public health campaign educating people about eating too much oil. If people are not saving enough for their retirement, it's the responsibility of the government to run a campaign encouraging people to save. So that's the concept of a patronizing state as opposed to a laissez-faire state. I've tried to explain that because it is these lessons from behavioral economics that provide a basis for consumer protection as an objective of financial regulation. As I said earlier, financial markets are different in several important ways. Financial products are complex, often unique. Savers and investors are handicapped by information asymmetries. I don't know as a saver how much the bank manager knows. So there's an asymmetry in the relationship between the bank manager and me. Or somebody who's trying to sell me a mutual fund, for example. That fellow who is selling me the mutual fund knows much more about that than I do as the consumer of that mutual fund. Also, financial markets have bubbles. They're difficult to see in real time. And when bubbles burst, savers and investors not only lose out because of their savings and investment going sour, but also because as taxpayers, we have to bear the huge costs of financial instability. So as the world, we learned these lessons the hard way. The global financial crisis taught us that We've got to be responsible in regulation. We've got to be responsible in promoting innovation, but also at the same time regulating the use of that innovation. So the surmise from the experience of the financial crisis is that in order to protect consumers, there has to be prescriptive regulation. That is necessary, but not sufficient. That prescriptive regulation has to be backed by an obligatory code of conduct by financial institutions. It is the combination of regulations and an acceptance of an obligatory code of conduct by banks that ultimately provides for consumer safety. Let me now move to the third question. Is financial innovation good or bad? This is admittedly a cliched question. And standard boilerplate answer is to say that it's not innovation that is good or bad. It is how that innovation is used, whether it's used well or used badly, that makes it good or bad. That's true everywhere, including in the financial sector. That if you carry excesses, they can be detrimental. Let me give an example from the financial sector about how innovations can be used well or used badly. Look at this use of quantitative techniques in finance. That's been a game-changing innovation, use of quantitative techniques in finance. It contributed enormously to the growth of the financial sector. This Black-Scholes model for option pricing. A lot of people think it's geeky mathematics, but it's also transformational. Before Black-Scholes model, people thought that investing was pure speculation. You did it on an impulse. You did it on gut instinct. It is lots of things, but maybe Black-Scholes is the most celebrated example of use of quantitative techniques. It changed the financial markets in a fundamental way because it showed that you can have a scientific approach to speculation. And it changed financial markets from being bull rings to quantitative powerhouses. So in a very fundamental, in a very influential way, Black-Scholes changed financial investment. A lot of things happened after that, including the award of Nobel Prize to one of those scientists who did the Black-Scholes model. But there were obviously limitations to the application of quantitative techniques. Because when we apply quantitative techniques, we're making models of the real world. And all models are abstractions of the real world. We're also making assumptions. So the big failure in using quantitative techniques has been, we forget to ask, does my model still represent the real world? Do the assumptions I've made, are they still valid? And oftentimes the answer is no, and then the model fails. For example, the LTCM, that hedge fund modeled on Black-Scholes, failed. So there was celebration by giving a Nobel Prize. There was condemnation of that model of quantitative techniques and all when LTCM failed. So that's an example from the financial sector of how an innovation can be used well or an innovation can be used in excess such that it loses its usefulness. So my simple answer to the question, is financial innovation good or bad, is that it is good only as long as it adds value to economic growth and social welfare. Now, this is the substance of my remarks today. What is the Reserve Bank's approach to responsible financial regulation? The Reserve Bank is the regulator for banks, non-bank finance companies, and large segments of the financial markets. Our approach to regulation has been to preserve financial stability and promote consumer protection. It is the obligation to balance these objectives of consumer protection and financial stability that has cast the responsibility on the Reserve Bank to take a measured and constructive approach to financial innovation. Now, you can operate on either extreme. On one extreme, you can say that, look, I'm responsible for financial regulation, therefore I'm going to tighten everything so much, I'm going to make it so safe. So I'll I control everything that banks can do so that banks are rock solid safe. But that comes at a cost. It'll cost in terms of growth, in terms of stifling innovation. I can go to the other extreme and say that I'm going to run a laissez-faire regime. I'm going to be nonchalant about whatever innovation takes place because I want innovation to flourish. But again, that can cause excess, and as I said earlier, it can cause an implosion with enormous consequences. So the challenge for regulators is to have the right balance between extreme caution and irresponsible nonchalance. And that's the struggle that we in the Reserve Bank try to manage on a dynamic basis. With that background, I now want to illustrate how the Reserve Bank has applied this approach to responsible regulation in certain areas. Take macroprudential policy, or what is now fashionably called macroprudential policy, but something that the Reserve Bank has been doing for at least 10 years. One of the primary causes of the global financial crisis, as all of us know now, was the excess in the US subprime housing market. Many people have described excess, I don't have to say it, but if I were to give a stylized description of an excess, it is that banks lent irresponsibly for housing to borrowers whose repayment capacity depended entirely on the value of the house increasing on a perpetual basis. Inevitably, there was a bubble which burst when house prices slumped, characterizing a classic Minsky moment, which is euphoria leading to panic and then to collapse. Here in the Reserve Bank, under the leadership of my predecessor, Dr. Reddy, we behaved responsibly. The Reserve Bank took measures to prevent such excesses in the Indian real estate and housing sectors by proactively instituting countercyclical measures, by raising risk weights and provisioning norms for bank lending to the real estate sector. That's how Reserve Bank approached regulation of the banking sector responsibly. Now let me give you another illustration, Basel III. Many people have questioned us about why in India we must adopt Basel III, on the argument first that Basel III is only required for advanced economy banks which have been behind the crisis. It is they who were responsible for the excess. Our banks behave very responsibly. They're sound and safe. Why do you want to implement Basel III? The second argument against Basel III has been that it might cost in terms of economic growth because it will raise the cost of credit. My response to those arguments is that it actually would have been irresponsible on the part of the Reserve Bank not to implement Basel III. We are a country that's rapidly integrating with the world, and we cannot have a regulatory regime, we cannot have a regulatory standard that deviates from that of the rest of the world. After all, Indian banks, many of the chief executives are present here. Our Indian banks are operating outside the country. Foreign banks are coming and operating in India. And in such a situation, when that penetration both ways is going to deepen, we cannot have a situation where our regulatory standards do not conform to global standards. To the second argument about growth, and that Basel III will hurt growth, my response is only to cite research by BIS, the Bank for International Settlement Economies, which shows that even if Basel III might impose some costs in the short term, it will secure our medium-term growth prospects. In the medium term, the cost-benefit calculus is very, very positive. The third illustration, let me look at new bank licenses, how again the Reserve Bank behaved, I believe, quite responsibly. One of the defining characteristics of responsible regulation is to be pragmatic, not to be dogmatic. That is, when situation changes, you change your views, you change your prescriptions, you change your rules in such a way that you continue to serve the larger public interest. A few months ago, we issued the guidelines for new bank licenses in the private sector. In contrast to earlier rounds of bank licensing, in this round we made corporates eligible for applying for bank licenses. We did that after very extensive debate, very extensive consultation, and after due deliberation. There was a lot of arguments against admitting corporates into banking. I won't go into all of them, but I'll just give you a flavor of the arguments that were raised against allowing banks to come into banking. The first argument was that banks are entrusted with public deposits. Corporates would misuse this large and cheap money for private gain by a coin, I don't know if that's a standard phrase, but Anand Sinha phrased it, by connected lending to their own units or to their customers and suppliers. That's the first argument. The second argument against corporates into banking is that the ownership structure of large corporates will open opportunities for regulatory arbitrage in case the apex unit, that's the promoter unit at the very top, setting up the bank, is an unregulated entity. If it's a regulated entity, we have some control. Somebody in the system has a control, but at the very top, at the apex of the promoter group is an unregulated entity, there could be possibility of arbitrage. The third argument against corporates has been that banking in the hands of corporates would lead to concentration of economic power and political influence. And finally, people have said, why do you need corporates? There are enough applicants, enough eligible applicants outside of the corporate sector. You don't have to open it up to corporates. In fact, the criticism has been much more varied and nuanced than the way I've said it, but I just thought I'd give you a flavor. Several stages over the last 3 years, the Reserve Bank has responded to that criticism. The main reasons we allowed corporates into banking is first to leverage on their proven entrepreneurial talent and management expertise. Indian corporates have been innovative in penetrating into the hinterland, and we wanted to leverage on that. And we believed that that enterprise will lead to innovation of new business models for financial inclusion. Second, large corporates can bring vast pools of capital that will go into strengthening financial intermediation and making our banking sector more competitive. Third argument is that corporates have been in other regulated sectors like telecom, airports, ports, etc., and they've also been in other sectors of the financial sector, like mutual funds, insurance, etc. So it's just an incremental step. It's not a quantum step. The short point is that over time, the balance of argument on whether we should allow corporates into banking or not allow them has changed. And it is reflecting the change in balance that the Reserve Bank, I believe responsibly, decided to make corporates eligible for banking licenses, because we believe that that will be in the larger public interest. At the same time, I want to acknowledge that the arguments for not allowing corporates into banking are non-trivial. They're quite weighty arguments. That's the reason we built several safeguards into the licensing regime. by prescribing demanding criteria for the corporate structure, for fit and proper criteria, for corporate governance norms, for exposure norms. There are requirements for dilution of the promoter's shareholding over time. And our people have advised me also that there's an inbuilt safeguard. It is that today a large business house is setting up a bank. They will, in their own interest, run the bank responsibly because they have a huge business interest outside. They're not going to stake the reputation, stake their entire business profitability to mismanage the bank. They have a huge stake in running the bank properly because they want to protect their entire business interest. Finally, the Banking Regulation Act has been amended to vest powers with the Reserve Bank to take action against bank management should the Reserve Bank determine that the management of the bank has been detrimental to public interest or to the interest of depositors. Again, I've gone at length on this issue to illustrate that every regulatory decision that we take is taken with due deliberation, and we believe with great sensitivity to the larger public interest. Then about financial markets, very briefly, I'll go through this quite quickly. We've been responsible in our regulation of financial markets as well. In regulating financial markets, we believed in three broad principles. First, that the menu of financial products available to hedge emergent risks should be widened. Second, the introduction of new products should follow a graduated process dictated by the acceptance of products by market participants. And third, the robustness of the market infrastructure for trading, settlement, and reporting of existing as well as new financial products should be improved. So what did we do in the Forex market, for example? We first set up the OTC derivatives market, the currency forwards market, in order to meet the hedging needs of the real sector by requiring that participants who participate in that OTC derivatives market have an underlying exposure. At the same time, we imposed limits on positions to prevent excessive risk-taking. After the currency forwards market had stabilized, we focused on the development of the currency futures market, which does not require an underlying exposure. And gradually we're developing that. Initially we started with rupee dollar. Now we've expanded that to other currencies, the rupee against the euro, the pound, and the yen. Over the last 8 weeks or 10 weeks, the Reserve Bank and SEBI have together imposed some restrictions on the futures market by way of raising margins and limiting the positions that market participants can take. Also, proprietary trading by banks was prohibited. As we explained in those circulars, these measures were instituted to curb undue speculation that was resulting in the volatility of the exchange rate. As indicated in our quarterly policy statement earlier this week, we will roll back these measures only after we determine that stability has been restored to the foreign exchange market. In the Reserve Bank's view, undue volatility of the exchange rate is harmful for growth and stability, and such volatility should be controlled. You would have thought that, and I thought so too, that when the LIBOR scandal broke up, the immediate reaction of regulators would be, oh, let's pounce on banks and correct this and let's take this over. Actually, I was quite surprised to see that internationally, at international fora, central banks and regulators behaved with a lot of restraint. They said that this is not something that central banks must be doing. This is something that banks must be doing, some other agency must be doing, but regulators and central banks must ensure that standards are maintained such that market participants and the larger public interest is not compromised. After the LIBOR scandal broke out, what did the Reserve Bank do? We conducted an audit of all the benchmark rates in Indian financial markets. The counterpart of LIBOR in India is MIBOR, the Mumbai Interbank Offered Rate. That's done by FIMDA NSE. And we did a poll and satisfied ourselves that the standards and integrity of determining MIBOR met the requisite safety levels and standards. The Reserve Bank also puts out the reference rate for foreign exchange at was 12 noon? 12 noon every day. Okay. So after the LIBOR scam broke up, we did an audit of how we determined the reference rate. And earlier we used to poll banks, we still do, but earlier we used to poll a fewer number of banks over a shorter time frame. Now we expanded the menu of banks that we poll. We expanded the time frame over which we poll banks, and we choose banks and the time frame at a random moment so that it is protected to the extent possible against manipulation by any interested party. Also, recently we appointed a committee under the chairmanship of one of our executive directors, Mr. Vijay Bhaskar, to go in comprehensively into all the financial benchmarks in India with a view to assessing the integrity of the process and the governance standards in the institution responsible for defining that benchmark. So that is an illustration of how the Reserve Bank takes its responsibility for responsible regulation seriously. My final question, and actually a question I have no answer, which is, does financial regulation have a role in promoting equity? It's a question that we struggle with as an institution, that I struggle with as the governor of the Reserve Bank. No, actually I started thinking about this much before that Sen Bhagwati debate came on scene, but in a way it's the same debate in a different sense, which is that for a long time the orthodoxy was that we take care of growth, equity takes care of itself, because a high tide raises all the boats. But experience taught us that no, you just can't take care of growth, you've got to take care of equity also, because you have to have not just growth, but poverty-sensitive growth. That is growth to which poor people contribute, growth from which poor people benefit. It's only poverty-sensitive growth that benefits the country. So the point is, how does the standard question of growth versus equity translate into the financial sector? Should stability and consumer protection be the sole objectives of regulation? Or should the Reserve Bank say that we will use our regulatory mandate also to pursue development objectives? To seek an answer to this question, we must actually ask a converse of this question, which is the financial sector left to itself? Is there equity promoting? Or it's in its pursuit of profit, equity is compromised? I'm not making a value judgment of any business model. It's just that in the financial sector, as you pursue a business, is equity automatically promoted or is equity not promoted? In the Reserve Bank, I think as a country we made that determination. In the Reserve Bank we made that determination, which is that financial sector nowhere in the world, including in India, is not automatically equity promoting. You've got to have a catalyst to push them towards equity. So our response has been to push banks and financial institutions towards socially optimal behavior. What did we do? We did priority sector lending. What did we do? We did lead bank schemes. Over the last 5 years that I've been in the Reserve Bank, we've done a lot of things towards financial inclusion. We've required that we've delicensed bank branch opening except in the metropolitan cities, tier 1 centers. However, we said that the licenses you get in tier 1 cities will depend on your performance elsewhere, how responsible you've been towards financial inclusion. We've required that all banks open at least a quarter of new branches in villages with less than 10,000 population, unbanked villages with less than 10,000 population. So we are furthering financial inclusion. We've taken up a number of development objectives to pursue through our regulation. The question is somebody's interest compromised? Because as a regulatory institution, we've accepted a responsibility towards promoting equity. That's something that we need to think through as a larger society and as an economy. That concludes the 5 questions that I thought that I said I will address. Let me now conclude by summarizing what I said so far. I started with explaining the logic for regulation in general, and then explaining how the financial sector is unique, requiring a different and more careful balance between regulating for stability and safety and at the same time encouraging innovation. I then spoke about good and bad financial innovations and how good innovations are those which add value to the real sectors of the economy. After that, I explained the Reserve Bank's approach to responsible regulation and illustrated that with examples from several activities of the Reserve Bank. Finally, I posed the question, does regulation have a role in achieving equity, without giving a definitive answer. Last year, in 2012, the Reserve Bank was awarded the Duvvuri Prize for Responsible Innovation by the Observatory for Responsible Regulation. The prize was given by the Observatory for Responsible Innovation in Paris. The Duvvuri Prize was instituted jointly by this observatory and Minds Paris Tech, a well-known educational and research institution set up in Paris nearly 250 years ago, to recognize remarkable and outstanding initiatives in the area of responsible innovation in finance. The Duvvuri Prize was awarded to the Reserve Bank for its calibrated approach to the introduction and regulation of financial products. I want to quote briefly, not very briefly, from the citation. I'm quoting, "The responsible character of the Reserve Bank of India's commitment in the financial services industry lies in an original and innovative regulatory approach for financial products. One of the Reserve Bank's priorities has been to calibrate the introduction of specific financial innovations in order to assess their behavior before larger scale diffusion, a pioneering approach at a time when the idea of considering markets as real-scale testing sites for financial innovation is not yet prevalent in the financial area. The Reserve Bank's calibrated approach introduces elements, a series of precautions, and pre-marketing and post-marketing surveillance that can stand as exceptional benchmarks for other countries," unquote. Thank you very much. The award of the Duvvuri Prize pleased us immensely in the Reserve Bank, but it also reminded us of our responsibility of ensuring that we continue to encourage innovation in the financial sector without compromising financial stability and consumer protection. We know that the Reserve Bank is not yet the best practice in this regard, but we will spare no effort to get there. Regulation and innovation must go hand in hand. Regulation is the responsibility of the Reserve Bank. Innovation should be the driving force of IDRBT, and all the banks present here. Together, we can make our financial sector resilient and make it an aid to growth of our economy and welfare of our people. So once again, thank you for this opportunity, and hearty congratulations to all the